Look at this graph. It's the trader's ultimate fantasy, a newly built strategy that boasts an 85% win rate, delivering a smooth, perfectly vertical equity curve without a single bump in the road. So you fund a live account, expecting to print money. But over the next 20 trades, that perfect system completely bleeds out, dragging your balance down with every entry. What exactly happened here? Did the global markets suddenly restructure themselves the second you clicked buy? Or was the trading logic flawed from the beginning? The reality is that most backtests are just polite lies. They exist in a sterilized, friction-free environment that actively deceives quantitative researchers into seeing patterns that don't hold up in the real world. To actually survive in live markets, you have to stop chasing flawless win rates and start hunting down the statistical ghosts in your data to uncover your true mathematical expectancy. Let's look at that 85% win rate again. If you test 20 trades and 15 are winners, it's just a lucky streak. Small samples are dominated by random noise, but by running 200 trades, we force those flukes to form a stable bell curve, revealing the strategy's true probability. But a massive sample size is useless if you pull all data from a single economic month, where the market only moved in one direction. This diagram illustrates why you have to stress test your rules across 3 distinct market environments: a smooth trending period, a tight, choppy range, and the erratic volatility of high-impact news events. Optimizing your system for just the last 3 months creates massive recency bias. You're building a strategy for an environment that is probably about to end, leaving your live account fully exposed. This brings us to the win rate trap. Many new traders obsess over being right, 80% of the time, treating their win percentage like a high score rather than a component of a larger equation. Look at these 2 models. Chart A wins frequently, but takes devastating losses. Chart B loses constantly, but captures massive gains when right. Compressing all those trades into a single net result makes the math clear. Strategy B is vastly superior, outperforming the high win rate model. This is the expectancy formula. It calculates the exact average financial return you can statistically expect every single time you click buy or sell, by weighing your win percentage against the actual size of your average wins and losses. If that final expectancy number is negative, the strategy is mathematically doomed. No amount of psychological discipline, tight stop losses, or risk management can save the account from an inevitable drain. Even with a positive expectancy on paper, hidden errors can artificially inflate your results. The most common culprit is curve fitting. Curve fitting happens when you add highly specific indicator rules just to make your historical data look flawless. You end up molding your strategy to past market noise, creating a fragile system that will never encounter those exact conditions again. Then you have the friction tax. Most backtesting software assumes you get filled at the exact price on the screen. It completely ignores real-world variable spreads, the inevitable execution lag, and slippage during heavy volume. To fix this, you have to penalize your own data. By manually deducting about 1.5 pips from the profit of every single historical trade, you simulate the friction of a live broker environment. A genuine statistical edge is one that remains consistently profitable, even after you force it to pay the friction tax of the live market. So you have a mathematically sound, friction-tested strategy, but you still shouldn't deploy it with your full account balance. Look at this timeline. To verify the system, we use a walk-forward analysis. You optimize your strategy on an older block of historical training data, and then blindly run those exact parameters through a completely unseen recent year to see if the performance holds up. Next comes forward testing, or paper trading. This proves whether you can physically execute the rules in real time and handle the emotional pressure of watching a live candle move against your position. Finally, you scale in using microlots. This introduces a real yet manageable financial risk. It acts as the ultimate test to verify that your live, real money expectancy matches your historical data before you commit serious capital. Ultimately, backtesting doesn't guarantee future wealth. It serves as a ruthless, mechanical filter designed to kill fragile ideas before they ever get the chance to touch your real money. To run these numbers on your own system, download the FXNX backtesting spreadsheet and use the advanced charting tools on NX1 to stress test your statistical edge today.